What if the biggest threat to your wealth over the next decade isn't a stock market crash, a housing bubble, or high inflation? What if the real danger is completely legal, highly calculated, and driven directly by the government you trust to protect you? General. Imagine working for 40 years, making smart investments, automating your budget, and successfully growing a meaningful financial nest egg. Then, imagine waking up to a severe economic restructuring where the state introduces emergency wealth levies, massive capital gains adjustments, and structural asset taxes that instantly confiscate 40% of everything you built. You didn't lose your money in a bad trade. You didn't make a reckless, speculative bet. You simply left your capital inside a system that was mathematically engineered to trap it. General. This is the ultimate macroeconomic warning issued by billionaire investor Ray Dalio, the legendary founder of Bridgewater Associates. Through his extensive research into 500 years of economic history, Dalio discovered an unshakable mathematical reality. When governments run out of money to pay for unpayable national debts, they always resort to the exact same survival checklist. First, they print money to dilute the currency. Second, when the printing press triggers catastrophic inflation, they aggressively weaponize the tax code to hunt down domestic capital. General. The retail public assumes that tax hikes only target the ultra-wealthy elite. But history proves that the top 1% have the institutional tools to move outside the lines, leaving the American middle class to carry the entire financial burden of the state's bankruptcy. In this video, we are going to dive deep into the Bridgewater playbook to conduct a brutal diagnostic check on sovereign debt. We will reveal the hidden historical patterns of wealth confiscation, how the global elite achieves structural sovereignty, and step by step, how you can use Ray Dalio's principles of geographic and asset diversification to make your portfolio legally uncrushable in the New World Order. Let's decode the machine. General. To understand why a massive global tax wave is mathematically inevitable, we have to look directly at the balance sheet of the empire. Ray Dalio's book, The Changing World Order, proves that every dominant reserve currency empire follows a highly predictable life cycle of debt. In the early stages of the cycle, the country produces more than it consumes, maintains a sound currency, and builds wealth on hard productivity. But in the late stages of the cycle, the nation becomes addicted to cheap credit, printing unbacked paper currency to sustain massive domestic deficits, welfare programs, and expensive overseas geopolitical obligations. General. Look at the United States today. The national debt is expanding exponentially, adding roughly $1 trillion of new obligations every 100 days. The annual interest payment required just to sustain this mountain of debt has crossed the historic $1 trillion threshold. The country is officially caught in a structural debt spiral. The state is spending far more money than it generates in revenue, and it is paying its old creditors by simply issuing new debt notes. General. Ray Dalio notes that there are only 4 ways a government can resolve a debt crisis of this magnitude. Option number 1 is an outright default, where the state tells its bondholders it will not pay them back. This is politically suicidal because it destroys the banking system instantly. Option number 2 is severe austerity, where the government slashes spending on infrastructure, military, and social security. This triggers an immediate brutal economic depression and widespread social unrest. Option number 3 is printing money to monetize the debt, which triggers severe inflation. Option number 4 is raising taxes to forcefully redistribute wealth. General. Throughout human history, every single empire facing this crisis has combined Option 3 and Option 4. They print money until the currency starts melting, and then they aggressively hunt down every dollar of domestic capital they can find. The politicians face a binary choice: let the state default and collapse, or use the legal monopoly of force to extract wealth from the population. They will always choose extraction. But here is where the middle-class trap closes. Most everyday retail investors keep 100% of their financial footprint tied to a single geographic jurisdiction. Their income is local, their home is local, their bank account is local, and their stock portfolio is held inside traditional domestic retirement accounts like a 401k or an IRA. To the state, this makes you the ultimate captive audience. When the government introduces emergency capital taxes, changes the rules of retirement accounts, or introduces hidden inflation surcharges, you have no escape hatch. You are sitting inside a financial cage, and the door is locked from the outside. Meanwhile, How do the ultra-wealthy, the corporate elite, and the multi-billion-dollar hedge funds managed by professionals like Ray Dalio handle this exact same threat? They don't panic, and they don't break the law. Instead, they operate on a framework known as structural sovereignty. Succinctly, Ray Dalio's entire investment philosophy is built on eliminating geographic and asset biases. While the average person views their home country as the safest place to store wealth, institutional macro managers look at countries simply as competing corporations. Some countries are well managed with low debt and high productivity, while others are poorly managed with unpayable liabilities and aggressive tax systems. The elite do not pledge blind emotional loyalty to a single financial jurisdiction. They treat capital allocation as a global game of chess. Succinctly, the corporate playbook centers on the concept of geographic neutrality. Multi-billionaires do not own assets in their personal names inside highly predatory tax jurisdictions. Instead, they use complex international corporate architectures, trusts, and foundations to legalistically separate the ownership of the asset from the country where they live. By distributing their wealth across multiple sovereign nodes, such as holding intellectual property in one country, manufacturing hubs in another, and liquid capital reserves in a third, they ensure that no single government can unilaterally freeze, tax, or confiscate their total net worth. If one jurisdiction turns predatory and hikes corporate taxes to 40%, they simply adjust their international accounting transfer pricing and shift their capital allocations to a friendlier node overnight. Succinctly, you do not need $1 billion or a Swiss bank account to apply the core logic of the Bridgewater playbook to your personal capital stack. Thanks to modern digital infrastructure, fractional asset platforms, and international brokerage accounts, everyday retail investors can build a mini fortress of structural sovereignty from their phone. The Dalio Blueprint requires shifting your mindset from domestic dependency to multi-asset geographic diversification. Succinctly, let's break down the exact capital asset allocation strategy to make your portfolio legally resilient in the New World Order, dividing your capital into 3 strategic pillars. Succinctly, pillar number 1 is the elimination of fiat currency exposure through hard assets. When a government faces unpayable debts, any asset that is denominated in paper currency is a liability. This includes cash in a savings account, corporate bonds, and traditional fixed income funds. The state can dilute the value of that cash to zero at the press of a button, or they can introduce a hidden tax via inflation. To protect your purchasing power, you must shift a meaningful portion of your capital into finite, tangible assets that cannot be manufactured by a central bank decree. Succinctly, Ray Dalio has consistently held that physical gold belongs in every structural portfolio. Gold carries no counterparty risk, it cannot go bankrupt, and it cannot be inflated away by a state deficit. When a government hikes taxes or devalues its currency, the nominal price of gold historically surges, shielding your real purchasing power from the state's extraction machine. For an everyday portfolio, allocating 15% of your capital to hard commodities like physical gold via GLD and diversified raw materials via DBC provides a structural barrier against currency debasement and domestic wealth taxes. Succinctly, pillar number 2 is the utilization of globally diversified corporate equities with strong pricing power. If you own shares in local, heavily regulated domestic utility companies, you are highly exposed to government intervention. When a state needs revenue, they can easily cap the profits of domestic corporations, mandate emergency corporate tax surcharges, or nationalize key infrastructure. To escape this trap, your equity module must focus on multinational corporations that generate revenues in multiple currencies across dozens of different countries. By holding broad global index funds like the Vanguard Total International Stock ETF, ticker symbol VXUS, combined with a broad total market tracker like VTI, you ensure that your capital is tied to global human productivity, not the local fiscal policy of a single politician. If the United States government aggressively raises corporate taxes, the multinational companies in your global portfolio will simply shift their capital expenditures overseas, preserving their net earnings and protecting your fractional ownership value from being hollowed out. Pillar number 3 is the integration of legitimate tax-advantaged hard assets, such as real-world infrastructure and specialized real estate investment trusts, or REITs. Throughout history, even the most predatory governments protect specific sectors of the economy from high taxation because they need the private sector to build infrastructure. The state always taxes consumption, wages, and passive cash savings at the highest rates. But they provide massive, legal tax shields for capital that is directly deployed into producing real-world utility, such as energy logistics, data centers, and industrial manufacturing facilities. One present, by allocating a portion of your capital into low-cost, liquid infrastructure ETFs or global REITs, you receive a consistent stream of dividend income that is legally shielded by institutional tax write-offs, allowing your capital to compound in real assets without being exposed to the standard domestic tax drag that destroys middle-class savings. One present, but the final most important component of the Bridgewater playbook is not what you own, but what you can personally produce. Ray Dalio's book, Principles, details that the ultimate form of diversification is the diversification of your personal value generation. In the late stages of a long-term debt cycle, the state can tax your property, they can inflate away your savings, and they can distort the stock market, but they can never tax or devalue your personal capability to solve complex, high-value problems for the global marketplace. One present, if your income is tied to a single local corporate salary, you are entirely dependent on the tax framework of that single jurisdiction. True financial sovereignty in the digital era means converting your personal skills into a global service. When you build international streams of income, master specialized digital capabilities that operate independent of geography, and learn to think like an asset allocator rather than a passive wage earner, you gain the ultimate leverage. You gain the capability to legally shift your physical residency or your corporate registration to whatever country treats your capital with the most respect. You stop being a captured consumer of a bankrupt state, and you become a sovereign participant in the global economy. One present, the upcoming wealth reset is not an accidental economic crisis. It is the logical, historical conclusion of an empire that has lived beyond its means on printed paper and unpayable debt. The system is moving exactly as the economic machine dictates. The middle class will watch their lifetime savings get systematically extracted because they are playing an outdated game with domestic blind spots. But those who eliminate their geographic biases, restructure their assets into uncorrelated global modules, and invest heavily in hard productivity will survive the paradigm shift, protect their families, and profit when the global financial architecture inevitably resets. One present,